Have you ever seen a stock price make a huge jump? Maybe it went way up, or maybe it went way down. The reason for these big changes is often an earnings report. Earnings reports are like report cards for companies. They are released every quarter. Investors watch them very closely. Companies are like students. They get graded on their performance. An earnings report tells you how much money a company made and spent. It shows if the company is profitable. This information is crucial for investors. Think of it this way. You wouldn't buy a used car without looking under the hood, right? Earnings reports give you a peek inside a company. You can see how well it's running. These reports can be confusing. They use a lot of financial jargon. Don't worry, we will break down the most important parts. By the end, you'll have a much better understanding of these vital documents. Let's open up an earnings report and see what's inside. Don't be intimidated by all the numbers. We'll focus on the key components. First, you'll see revenue. This is all the money a company earned from selling its products or services. Think of it as the company's total sales. Next up is net income. This is the money left over after deducting all expenses from revenue. It's the company's profit. Higher net income is always a good sign. It means the company is making money. Now let's look at earnings per share or EPS. This number tells you how much profit the company made for each share of stock. It's a way to compare the profitability of different companies. Finally, we have guidance. This is where the company tells investors what it expects to earn in the future. It's like a sneak peek at their next report card. Positive guidance can boost investor confidence. Why should you care about earnings reports? They are full of valuable information. By analyzing these reports, you can make smarter investment decisions. You can spot trends and identify potential risks. First, earnings reports help you understand a company's financial health. Is revenue growing? Is net income increasing? These are positive signs. Declining numbers could signal trouble. Second, these reports help you evaluate a company's future prospects. Is the company investing in growth? Is it paying down debt? These factors can impact its long-term performance. Third, earnings reports help you assess the risk of investing in a company. Are there any red flags in the report? Is the company taking on too much debt? Are profits declining? Now that you understand the importance of earnings reports, how can you use them to your advantage? Here are a few tips. First, don't just focus on one quarter's results. Look for trends over time. Is the company consistently growing revenue and earnings? Second, pay attention to what management says. Companies hold earnings calls after releasing their reports. Listen to what they have to say about their performance and future plans. Third, don't be afraid to do your research. There are many resources available to help you analyze earnings reports. You can find analyst reports, news articles, and even online tools. Remember, earnings reports are powerful tools. By understanding them, you can gain a significant edge in the market. So, next time you see a stock making a big move, check the earnings report. You might just discover your next winning investment.